Hello, Profit Hackers. I'm Jeremy Lott, the Chief Visionary for Foundation Accounting and Consulting. I owned a construction company for about 15 years before making a change to accounting because my accountants sucked. My goals are to simplify accounting for construction company owners, fuel your profits, level up your cash flow, and help you grow in a financially responsible way. So let's go. Welcome, Profit Hackers, back to the Contractor's Profit Hacks Show. I'm doing something a little bit different today. It's a little bit of a special episode. I am doing my first interview. I'm here with a good friend of mine, Rob Hutton from Edward Jones. He is a genius, and I love working with him. And we're going to talk to him a little bit today about his strategies and how he approaches investing and just kind of some general concepts. I want to throw out here that this is not tax strategy specific to you. If you want strategy for investing, for taxes, for any of those purposes, you need to go talk directly to your tax advisor or your financial advisor because they'll know your situation. So today we're just going to talk about kind of some broad terms and broad ideas rather than giving specific advice on what to do with things. So
if anything, I was going to say, I hope that people walk away with questions to ask.
Yeah.
As opposed to feeling like any answers were given. We're certainly not going to be giving advice or making recommendations as to what anyone ought to do, but perhaps some of the things that they might think about that have heretofore gone overlooked in their discussion.
Yeah, awesome. Yeah, I met Rob through a networking organization we're a part of called Connect Utah. He is a community director and moderator for the group and fulfills many other strategic positions for the owner of the organization. And we found out that we went to the same high school, and he knew my little brother. And so I instantly liked him because a lot of pride in our high school.
There's a bit of it, yeah.
Yeah. And I was fascinated to hear about his story. He was heading down a political path. Correct me if I'm wrong.
That was the goal. More diplomacy than politics,
right?
But certainly very political adjacent.
Right. And then ended up in the circuses helping to free mistreated animals and all kinds of stuff before landing finally on financial advising, which you've been in for 20 years?
So I've been licensed 18 years
18.
Now.
Okay.
And I went to school with every intent of being the next Secretary of State, being in Washington, D.C. for my undergraduate. I was very, very close to a number of things, not the least of which was a little bit of the disenchantment that a number of people who were pursuing the same career path as I and maybe farther along that they were able to share in their own experiences that suggested things don't always work out as you might plan. There's a level of meritocracy that is often overlooked, and it's more who you know rather than what you've done. Knowing that I just didn't have those same opportunities led me to look elsewhere, but also being in Washington, D.C., you're so close to so many different organizations. So I was able to get in with the United States Humane Society, Humane Society of the United States, HSUS, and other organizations to work on some things that financially I couldn't make the same sacrifice once the student loans come due and you have a family.
Right.
But working for nonprofit when you have no other obligations is a great opportunity. And I think when I realized that my career was not going in the diplomatic realm that I wanted, that the State Department wasn't probably for me, I geared my education more toward economics and found that the path led me to ultimately working in the financial service industry, being licensed now for 18 years.
That's awesome. That's a really, like I said, I just love his story. It's very cool. It's so cool to meet with people that have been diverse in their background rather than just kind of one path from beginning to end.
At times, I kind of envy those people who've been able to identify that path early, forge it, but at the same time, it's the perspective gained from being down so many different paths, oftentimes failing in a path that I think truly enriches people. You have so many stories, so many individuals who discovered the pitfalls that they're trying to help others avoid because they found them themselves.
Yeah. Your mess is your message.
Yeah,
right?
exactly.
I mean, the profit hackers here, they all know very well about my story and how my mess and huge failures became my message now and what I'm teaching and helping people with. So, yeah.
I was fortunate growing up with a great deal of Scottish background and influence. I never was willing to take the risk to put myself in a position to quite take on the mess.
Yeah.
But no, I very definitely I come to this because of a good deal of financial stress and a grandfather who passed far too young, and that legacy of worrying so much about having to take care of others and having a sense of financial obligation and a sense of financial scarcity being so much the message with which we were raised. So that is a great deal of what brings me to where I am, and it's more the inherited mess, which I would even argue is oftentimes more a perception of mess. We have a tendency to look at what we imagine the ideal is or ought to be, or we look at what other situations, others' models are, and if ours doesn't feel like it's fitting that, then sometimes we express that as failure, or we feel like that's a shortcoming, a shortfall, when the reality of it is everyone's situation is so entirely unique, and everyone needs to look at their specific scenario rather than trying to liken themselves to somebody else to identify where their victories have been and where they should be. Because there are so many times that people, while we're on the subject of money, people misinvest because they think that they need to keep up with somebody else. They think that they've heard of somebody else investing in cryptocurrency and the fantastic return, so they think that's where I need my money. There may be great gains to be had in following what has made others successful, but oftentimes you're also opening yourself up to risk. And in the case of business, sometimes you're trying to follow in the lines of an already plowed field.
Yeah.
And it's not necessarily going to give you the success that you're looking for.
I like that. I like that a lot. As you're talking about that, it reminds me, I perhaps you would be willing to be a little bit vulnerable. You care a lot about your clients and helping them not just to make ends meet, but to build wealth and to be prosperous. I know that stems a little bit from what you started talking about with your family life and what your father went through. I'm wondering if maybe you would be willing to
absolutely.
Share a little more detail on that.
So my grandfather came over to the United States after World War II. He was at least once taken prisoner of war. He was a combat wounded veteran, and he was an immigrant to the United States. With his health, his long-term physical conditions, as well as just immigrant status, he was very blue collar, working to make ends meet. It was a different time where certainly one person could provide for a family, and the trades are once again booming in that regard. It's great to see, but at the time, in in a trade, he was able to provide for his family. He had 4 children, but it was not as though there was a great deal of wealth to share. And I think he always approached life as though he was going to work until the day he died to make sure that he provided.
Yeah.
Unfortunately, that death came, I think, far earlier than any of us expected. It was before I was even born.
Yeah.
But he was 56 years old. He died of a heart attack.
Oh.
His wife, my grandmother, was 49. She had not worked since dropping out of nursing school to become his wife and the mother of his children. My father was the eldest son. His older sister, as well as his younger sister, were both in college at the time, and his younger brother was still living at home. When my grandfather passed, my father took on the financial obligation. He took on the provider role now for 3 generations. His mother, his siblings, and my sister, his newborn daughter. She was only a few months old at the time. And so with that, my father created within himself this sense that it will never be enough, because his model was that he may pass, leaving children still in a position of need, a spouse who was not fully able to provide for the needs of the house, because that's what he saw.
Yeah.
And up until my 20s, my father was financially providing for his mother until she passed. He was helping provide for her in hospice and in memory care. And that burden was something that, to a degree, I inherited. That's where I talk. That's where I talk about being so risk averse that I didn't have the opportunity to create my own mess, so to speak.
Right.
But it still, to this day, my father's now retired and doesn't hardly use his assets. He and my mother could get by on Social Security and their small pensions and never touch their retirement, but they're still avoidant of overspending simply because it has become such an ingrained aspect of their life.
Yeah.
When I decided upon a career in the financial field, I wanted immediately to be an advisor to help rid people of that financial fear and stigma and create for them a healthy relationship with money such that they could start a plan, stick to a plan, and ultimately put themselves in a position where the comfort that they have built for themselves during their working days is something that they're able to carry over into retirement.
Yeah.
We don't want it to be that suddenly, things step up substantially and you have an abundance of wealth, but a scarcity mindset that you won't relish the fruits of your labor.
Right.
But we also don't want it to be a situation where you've done so well throughout your career that when you arrive at retirement, you realize the level at which you've lived is unsustainable. Mm-hmm. And I think those are unfortunately, those 2 outcomes are more common than people comfortably transitioning between working and retiring.
Right. Well, and that mindset, like you've illustrated here, that mindset is generational.
Oh, it absolutely
passes on from one person to the next to the next.
I grew up thinking we were poor.
Yeah.
I grew up thinking that we didn't belong in the community that we lived in because it felt like everybody around us had more.
Right.
And it was actually a matter of frugality, that we didn't spend on things that were unnecessary. And that's something that I have a hard time breaking of with myself. I have a hard time spending money on myself.
Yeah.
But with my family, I have a hard time saying no because I don't want I don't want them to
be subject to that.
But I have significant guilt in overspending on myself.
Yeah.
And so it's a very interesting thing. There's so much emotion associated with money that I think people fail to think about it from a truly pragmatic sense.
Yeah.
And with all of that emotion tied to it, we also need to recognize how early that manifests itself. The first time you tell your kid that there isn't money to participate in sport, an extracurricular, dance, whatever it is that interests them, if the reason is that we can't afford to,
Yeah.
then that is something that they can carry with them.
Yeah.
And so a lot of what I try to do in working with people and communicating with people, and this is certainly not a matter of financial advice. This is just suggesting how we frame our relationship with things, is prioritization as opposed to thinking of it in terms of scarcity or abundance.
Right.
Because if you prioritize something, there is money for it. And if there's not money for it, then it's because it's not a priority.
Right.
And in how we communicate that both to ourselves as well as our children, there's immense power. If you tell your kid you can't play football this year, there's just not money for it, as opposed to communicating to them that there are other things that this year are just a little bit more important, and I don't know as there's going to be the opportunity to play football this year. It sits with them completely differently.
Oh, yeah, I see that.
Because if you tell them there's not money for football this year, then they're going to start asking, well, why is there money for other things? But if you express to them that because of other priorities and a need to address other things first, that football falls down and will consider it, then they don't think about it in terms of what is it that was taken away from me, but what was provided to me that was deemed more important.
I like that.
And when they recognize that that was deemed more important, then they can start to ask those questions. And maybe they say, well, I will pass. I don't need a ski pass. I don't need a new bike. I don't need certain other things. And they can then express to you where their priority is.
Yeah.
And for kids, you and I grew up playing with, football was a priority to which they would make other sacrifices.
Right.
But if it was simply dictated that there wasn't money for it, that's the end of the conversation.
Yeah.
And that creates a scarcity mindset. It's now we need more money, not we need to think about the priority of things.
Right. Yeah. I love that. And this mindset really is prevalent among the trade workers and other blue collar people here in our country and right here locally where we're at. So one of my contractors comes into your office. They have this scarcity mindset and they hold on to their money really tight. There's that constant fear that they're not going to have enough and they're just really not living abundantly. Obviously, you can't jump right into, well, let's invest here and here and here and here. Probably a lot more discussion first. How do you approach that? How do you help somebody to start thinking a little bit differently?
Well, the very first thing that any conversation should start with when there's discussion of assets in use is what is your risk profile from an emotional standpoint, from your mindset regarding money, but additionally, what is your risk in terms of your outstanding liabilities? What is your risk in terms of the exposures that you might have? A contractor walks in, and depending on the structure of their business, they may have significant payroll liabilities. They may have significant liabilities associated with the closing of business, on a net 30, net 60 basis, where they may be cash flush, but they're also responsible for taking care of all of the business expenses and maybe even doing the front loading of the payment of work that they're not going to see paid for until months later. So it becomes then a question of what are their concerns, but additionally, what are the concerns that they may be blind to? Because they may be walking in thinking, I'm cash flush. I have so much money. I feel rich in this moment.
Yeah.
and they jump into an obligation. They jump into a position that exposes them then potentially to further risk that they ought not. And too often we have this mentality of let's make a plan when let's put together the recipe when we've brought in the kill. And that's not the way that we should go about it.
Right.
So often people say, well, I have this with which to set the table, with which to feed everyone, but I have no idea how to cook it. Instead, you need to learn how to cook so that when you have that harvest, that kill, you have the ability to approach it in such a way that's not going to waste it, that's not going to be the wrong recipe, the wrong approach to how you prepare that, how you cook it. And that starts with the building blocks of along the way, as I'm building my business, what am I doing to set myself up for when that day comes? What am I doing to set myself up for when I start to have positive cash flow? What am I doing to make sure that I don't have significant liabilities that hinder my ability to get to the point of cash flow? You don't want a balloon payment that you're not going to be in a position to be able to make.
Pay. Yeah.
And so much of it also is about learning the discipline such that if you're able to sustain yourself on less than what you're making in your greatest days, when the bad days come along, you're more easily able to adapt to them. You're able to recognize at that point what is important rather than going into absolute panic mode and saying, well, we can't pay for everything that we've set ourselves up for.
Yeah.
And there are times that it's sink or swim. You're swinging for the fences where you've found that opportunity and you've put yourself in that position. But putting yourself in that position from a business perspective and putting your personal life, your personal assets, your family in that position are and should be in most cases two completely different things.
Right. Yeah. Agreed.
But we have a tendency to ignore that. And one of the most beautiful things of the entrepreneurial mindset that I think a lot of people in the trades have, one of the beautiful things about it is the insistence on betting on oneself, doubling down on saying, I have the work ethic to make this work. I will reinvest within myself because I know that I will not give up until I've achieved what I'm after.
Yeah.
But it's a hubris. It's entirely commendable. It's great. It's one of my favorite things to see people with that drive and that ambition. But to do so at the risk of losing everything is, I think, one of the biggest mistakes that people make. You almost have to have the side bet against yourself. And that's so difficult to get somebody to embrace.
Yeah.
You can't put yourself in a position that the factors that you can't control become the ones that crush you. Economic turns happen. They're out of our control. There are different things that might come up. I mean, we can look back 5 years and look at the state that so many contractors found themselves in because people canceled projects. People couldn't come in to work in your home.
Yeah.
Supply line shortages left people in a state that there was very little that they could do. It was outside of their control. And it was one of the most frustrating things, I think, to people with that entrepreneurial spirit, because they could say, well, I'm doing everything I can.
Yeah.
But my hands are tied. And then for those who made it through, we had one of the biggest booms for the trades, for contractors, as quantitative easing, the lowering of interest rates, and the freeing of capital made it easy for everyone to do that project, to hire someone to come and add on to their house, or simply to build a new house because of interest rates acting in their favor. We saw this tremendous boom, and I think that set people up for a false expectation of what reality could be.
Right.
And so for those people who have weathered that, for people who've been in business greater than 7 and 8 years, they've seen where their traction was halted by conditions outside of their control, and where they reaped a harvest, a benefit greater than they ever could have imagined.
Right.
And if we allow ourselves to completely swing to the extremes of where either of those take us, we're setting ourselves up for failure. But if we can find the narrow path between the two,
right,
where we're able to make it in tough times, and where we're able to still reap the benefits of the great times, but not allow ourselves to become decadent within them.
Right.
That is the path that's, I'm sure, what you focus so tremendously on as you go through balance sheets, but it then becomes a behavioral aspect farther down in our personal relationship with the money that we get from work and the opportunities that we take.
Right.
You know, ask the contractors who bought a boat in 2020 versus the ones, or 2021 versus the ones who invested either in their business or in themselves.
Right. Or in 2019.
Or in 2019, or, you know, I told you I've been doing this. I've been in this industry for 18 years. I got started just a year before things fell apart in 2008. I've been licensed since 2007, and I was ready to take the world by storm. I was young, brash, had a fancy degree, and I thought, you know, I'm going to tell everybody how much better I know than them. And then reality set in where I said, this isn't a risk that I'm willing to take. This isn't something that I can take on at this time. And, you know, I was fortunate to be in that situation to make that decision for myself. I was young. I didn't have other responsibilities aside from my student loans. And so I was positioned well to do that. Not everybody has that to where you can simply respond to the conditions. You need to position yourself to where the conditions don't have the absolute impact that they might otherwise.
And get a little creative.
Be cautious. There's no reason not to celebrate one's victories. It's one of the biggest things I tell people, because otherwise they are going to end up in that mentality where they get to the point of retirement and they can't spend on themselves. They've coached themselves to avoid spending on themselves. So you have to be celebratory of your victories, but you also kind of have to move on from there.
Yes.
You know, going back, sorry, I use a lot of sports analogies, but going back to what we were talking about, you can get a flag thrown on the play for excessive celebration. I think we need to take that same mentality into how we approach our successes in life and business from a financial perspective. So somebody's got to be there on the sideline to flag you and say, you know, this is a little too much. You're setting yourself up for failure, and you know, in some cases, you're putting yourself in a position where you're jeopardizing not just yourself but your team. And that's, the analogy falls apart a little bit at that point, but it still is a situation where if you've done too much, if you've taken things out of play, out of putting them back into a safety net, back into the business, back into a situation where they are useful for future state, then yes, when the defense has its walls up against you, you are jeopardizing your team because you celebrated too much.
Yeah.
You don't have the energy, you don't have the goodwill in some cases working for you.
Yeah. This is awesome. And if you don't mind me summing it up, Rob is talking about managing cash flow. That's what he's talking about here.
Yeah, I mean, so cash flow isn't just about did this bill get paid?
Right.
Cash flow isn't just about how much is going through, but it's positioning things in such a way that you're addressing future concerns of cash flow. You're effectively getting the biggest hurdles out of the way quickest.
Yeah.
Sometimes it doesn't come down to interest rate. And
Right.
That's one of the biggest fallacies that drives me mad. It's because that's simple. But, and Jeremy, you and I have talked about this before. If I've got a car that I owe, or it's a truck, part of your fleet, whatever the case may be, but I've got a vehicle that I owe $5,000 on, and my monthly payment is $800.
Right.
People will think, well, you shouldn't pay that off if it's only at 2 to 3%. But from a cash flow perspective, if I've got $5,000 to throw at that, I just freed up $800.
Yes.
And that $800 is more than enough payment for a $25,000 line of credit.
Yes.
That might otherwise benefit me, even if it's at a higher interest rate.
Right.
So simply by freeing up that $5,000 or that $800 a month by sacrificing the $5,000, I've positioned myself better.
Right.
We think too often in terms of what am I paying in interest? What is my interest rate? What is the total balance? And not in what is the impact if I take this action now on where it puts me in 4 to 6 months.
Yes. People are so afraid of interest rates that they avoid really good investments that could give them a lot of positive cash flow because they don't want to spend 40%. They don't want to spend 30%, whatever the astronomical interest rate is. And they miss out on a lot of opportunities because of that.
Yeah, and I'm not encouraging somebody necessarily to go out and take on high interest rates.
Right.
There's absolutely no suggestion of that. But it's more about thinking about the outcome of what the money is spent on than it is thinking about where the money is going within that payment.
Right.
And if you can put yourself in a position where you have flexibility within your capital expenditures because you have liquidity, because you have greater flows in relative to the obligations outward, as opposed to looking at your balance sheet and saying, well, I have this much equity and this much liability.
Yeah.
And you have that chart we were talking about that earlier. We'll touch on it more later, but one of the biggest things that we touched on there was it's not about then the revenue within business, it's about the equity in business when you get to a certain level. At an earlier stage, when we're talking about operating at a household, small business, solopreneur to 50-person team, that is the point at which businesses are dependent upon not just the people within them, but the structure of their cash flow, not the equity, not the overall worth.
Right.
It's at some point there is a value in the brand, but that doesn't come.
Right.
And until you've gotten to that point where you have ultimate value in the brand beyond how you've branded yourself and beyond how you have a personal reputation within your business, you need to be considering all of the conditional changes that might happen from a month-to-month basis for the sake of your business, your family, and the families of those who work within your business or are dependent upon your business.
Yeah, exactly.
Even, Jeremy, you pretty much one-man show, but you've got a lot of businesses that are dependent upon you to help them operate on their 3 to 6 month plan. If something should happen where you didn't structure yourself appropriately and you had to step aside, you had to move out of the business, or something just happens to you, there are other businesses impacted.
Yeah.
And people, I think, also fail to recognize that within their own business, how are their employees impacted?
Yeah.
We're very, I won't call it selfish, but very, very focused on the immediate and personal effect of the things that we do, and particularly with money. And we oftentimes lose sight of the fact that within a business, there are others who are impacted. And if those others are impacted negatively, then in turn, your business and your own productivity is going to be impacted negatively. We hear too many stories of people setting aside their payroll concerns for new equipment.
Yeah.
for other things that might ultimately, and this is where I say that it's okay to take a gamble on yourself from time to time.
Right.
But where it may pay off in the long run, but in the short term,
Right.
you've
Lots of pain.
Yeah.
Yep. Awesome.
So what do you run into most often that you feel is a pain point for your growing businesses, particularly a point at which they say, I don't know what to do here? What's
Right.
most common for you?
So it is cash flow, 100%. I love to pick on excavators
Okay.
because they have pretty good margins. They bring in a lot of revenue. They have a lot of cash coming in the door, right? And what I see so often with excavators is that they love their toys. They're always buying the next loader or, whatever it may be. And they go out and they pay cash for it. So they get $100,000 in the bank and they take $80,000 of that cash in the bank and dump it into a piece of equipment that, will make them more money and help them out. But they've made themselves cash poor in the process of doing that. And then they come to me and they say, I just can't ever keep money in the bank. And so that's kind of an extreme example where they're buying really large equipment. But all across the trades, that is exactly what's going on, is that they have no strategy for spending their cash. It's just, we have it in the bank. Here's my stack of bills. I'll pay this, I'll pay this, I'll pay this. And they go through the stack until they get to zero in their bank account and then wonder why they're having problems with being able to pay themselves and having cash in the bank.
And, some of it I think is a tax strategy. Oftentimes, investing within your business, creating the business expense so that you have the write-offs, things along those lines, to put yourself in a position to not have a significant tax liability at the end of the year. Because, yes, that excavator, that loader is more valuable to your business at $80,000 purchase than paying $20,000 to the IRS.
Right.
However, the $60,000 in between the prices is what's really in question, because that $80,000, while it is a great asset, future depreciation, wonderful way to strategize for your business, and ultimately something that can earn money for you, if it puts you in a position where you don't have the ability to address other liabilities,
right,
it's ultimately doing you no good.
Right.
Now, this might come across as highly controversial, and I don't mean to get political in any way with this, but anyone who has a significant tax obligation should consider themselves fortunate. It's a good problem to have.
It is, yes.
There are ways to decrease it, and certainly there are good ways to decrease it in such a way that you're not handcuffing future opportunities. But simply trying to get to a zero tax position is not realistic or responsible for most small business owners and most
Right.
contractors, because it means overextension of your cash position. And it means taking on liabilities that are potentially going to hinder future cash flow. And it certainly means putting yourself in a position that if work dries up, you're left with not a lot of capital, a whole lot of depreciating assets.
Yes. Yeah.
And that's again, I get it. Entrepreneurial, once again, we don't like the idea of taxes as entrepreneurs. It's kind of this idea that we're out for ourselves. It's a cowboy mentality.
Right. Yeah.
And it's great. It's admirable.
Yes.
But there are times at which we just kind of have to say, well, even the best cowboy is at risk of shooting himself in the foot. and we've got to just take a step back and say, for all of your successes, there's a penalty, there's a tax.
Yeah.
And nobody wants to hear that. And I don't mean to be tongue in cheek in calling it controversial or anything along those lines, but it is one of the things that at some point, one of the difficult conversations that I do have with some of my clients is, well, we can lower your taxes to this, but anything beyond that, and you're giving away money, you're stepping
Right.
over dollars to save pennies.
Right. Yeah. 100%. I want to move forward onto the investing stuff.
Okay.
In my research and education, I see investing as beneficial for basically 4 different categories. The first is tax planning and lowering your taxes as much as you legally and responsibly can. Number 2 is obviously for retirement. Number 3 is diversification, so that you are protecting your wealth. And then number 4 to me is cash flow. And there are investments out there that will cash flow. And I want to get into that in more detail. But first I want maybe your 2 cents worth on those 4 categories. If you see there being other categories or whatever, as the expert, help to educate us.
Well, diversification and retirement for the typical entrepreneur, for me, those go hand in hand.
Yeah. Okay.
And it's diversification against your business. You're not typically going to invest in your competitors just because A, you don't want to. B, it's not necessarily a beneficial way to spend your money. It gives them a leg up. But additionally, it's just something that emotionally we don't tend to. So when we invest, we tend to be invested in different sectors. And it's the diversification against the value of your business that ultimately opens the door potentially for retirement. Because everyone out there, I hope, likes what they do. And even more so, I hope they love what they do. But if you asked your clients, do you want to have to do this until the day you die? Most of them are probably going to say no. They probably have some point at which they want to exit the business. Now, that's not always in our control.
Right.
Especially for people in the trades who are reliant upon their physical ability to conduct their job.
Right.
How many plumbers out there have bad backs? How many handymen have arthritis? How many contractors have bad knees from walking the job site all day long? It's outrageous, the physical toll that people take on themselves and the age to which they demand that they work because they haven't typically diversified.
Right.
And particularly now with our tradespeople making more and more, their skills are becoming appropriately more valued.
Yes.
At a younger age, tradespeople have the opportunity to invest more within themselves. I think we go back, look at the folks who are retiring now, who I guess we'd say are almost 2 generations ahead of those entering the workforce now. But their skills may not have been as valued. Now we're putting more emphasis on it. We have fewer people who are trained properly in the trades. And so there is a premium being placed on that. And there's greater opportunity to prepare for one's retirement, to diversify at a young age. If you invest simply for the sake of investment of future value and growth, but you do so back within your own company, certainly that can pay greater dividends. It's going to grow probably more than any other investment that you might find out there. But it's the diversification that ultimately will allow for retirement. Because if something happens to you at age 50 and you have to take an early exit from the business, what's to guarantee that your business is at an appropriate stage to be able to exit, to sell in such a manner that is going to take care of you for an early retirement?
Right.
No, there's no guarantee in most other investments, and I would argue that anything that is an investment, there is an inherent risk.
Right.
It comes without guarantee. If there is a guarantee, it's not an investment. It's paying somebody else to earn money off of you to receive less in return.
Right.
Is what I see it coming down to. But there is absolutely the ability then to diversify against the potential undervaluation of yourself within your business, the timing of the necessity to exit business, future risks that may come up, but also just recognizing that a lot of industries are cyclical. And, it was great. We saw the Fed's lower interest rates by a quarter of a point today. But if interest rates remained at 5, 6, 7% on mortgages for too long, without housing prices coming down, without the ability to potentially build at a lower cost, there are going to be a lot of home builders, a lot of contractors who found themselves in prolonged
hard up for work.
Yeah, and then where's the value in the business?
Right. In the business owner.
It's solely in the business owner because it's not in the number of contracts that you have. Right. It's not in your volume. It's not even necessarily in your visibility at that point.
Yes, I got it right.
So there are a number of reasons why diversification and retirement to me go hand in hand.
Okay. That makes sense.
Because it's not just about having your money in different pools. It's about diversifying the focus of where you put your money.
Yeah.
Because a lot of business owners do invest, but they invest back within their own business. They invest in trying to expand things. They buy that other loader, that other excavator. And with that's investment, absolutely. There's no question to it. But it's not diversification, and it doesn't promote one's retirement. Now, from a cash flow perspective, yes, there are a number of different opportunities to invest in such a way that will either generate monthly or quarterly income.
Right.
And sometimes that is the best thing that a business can do, because money sitting fallow, not being invested, just sitting on the sideline,
yes,
can actually put somebody behind. If you think about the inflation that we've seen over the last 7-8 years, things have a tendency to accelerate.
Right.
But we never typically actually get to deflation. We'll go into disinflation. So inflation, obviously, goods and services costing more, and sometimes significantly more, particularly in raw materials. Deflation would be actually coming down in price. Disinflation just means a stagnation of the price. So it's gone up and holds steady.
Yeah.
We see disinflation a lot, where the cost to acquire the raw material, the cost for them to go out and log to get the wood may have come down, but you're still paying just as much at the lumberyard for the wood as you did 6 months earlier.
Right.
They're not going to bring that price down.
Right.
You don't tend to see deflation where the cost of a produced product, no matter how raw that material is, goes down.
Yeah. People have recognized, or the market, if you will, has recognized what the threshold is, what people will pay, and why would they charge less than that.
Exactly. So even at raw material stage, I mean, unless we're getting, absolutely into commodities and we're talking about,
Right.
timber, raw timber, not even lumber, raw timber,
Right.
and, iron ore and things along those lines, unless we're getting to that, you don't tend to see deflation.
Gotcha.
And so because of that, the need to ensure a positive return or cash flow on your cash holdings is substantial. If you're not keeping pace with inflation, every dollar that you set aside ultimately is worth less by the time you go to spend it than it was when you set it aside. This is one area that I have never been able to reconcile the mentality.
Okay.
But so many of our contractors, of our tradespeople, have significant cash holdings, not in a bank,
Right.
not in a financial institution,
Okay.
in a safe in their home,
Yes, that's true.
physically held.
That's true.
And okay, great. Maybe
It's the whole, if I get paid cash on a job, I don't have to pay taxes on it. Is that contributing factor?
I think that is a contributing factor, and that was what I was going to say next. Is I understand that maybe there's a tax aspect to it, but typically the amount that we're talking about isn't going to trigger some sort of tax investigation. We're not in a situation where people are sitting on millions of dollars.
Right.
Oftentimes, yes, I've seen it in the six figures in a safe.
Right.
But it's six figures that didn't come from a single job. It's been accumulated over a number
time.
of years.
Mm-hmm.
Well, every year that's in there, on average, it's worth 3% less than it was at the beginning of that year.
On an average year.
On an average year. In a bad year, that might have gone down in value by 10%. Well, if you're able to even keep pace with inflation, with cash flow, with interest payment, that does less damage to your overall position.
Right. Yes.
Just going back to the notion of buying that next piece of equipment, an $80,000 excavator or loader wasn't $80,000 10 years ago, and it's definitely not going to be $80,000 in 10 years. It was 60, maybe even less 10 years ago, and it's probably going to be 100 or more in 10 years. If you put the $80,000 in your safe saying, I'm going to need one in 10 years,
right,
you better come up with another $20,000. And that's just the reality of it, that there is always going to be a trend of inflation.
Mm-hmm.
And that inflation can come from a good economy that's going up, and as a result, we have goods and services becoming more expensive because everybody's earning more, and overall growth is fantastic. It can also come from a bad economy. A bad economy can cause inflation as we see the value of the dollar deflated against foreign currencies, where a dollar just doesn't buy what it used to. Quite literally, when we exchange a dollar into a euro, if it's worth less than any products that are being sold on an international market, we have to compete with currencies that aren't necessarily changing at the same rate. And as a result, we experience inflation because it costs us more because our dollar isn't as strong. Right. So in a good economy or a bad economy, we're going to have inflation. It's very, very seldom that we won't have inflation, and people need to prepare for that. They need to plan for that. If that comes in the form of just putting your money to use through an investment for long-term purposes, or if it means keeping that liquid and making sure that it is generating monthly, quarterly dividends, interest, whatever the case may be, it needs to do something.
Right.
And maybe it's because I was raised with the scarcity mentality of we need every cent we can get.
You and I both.
Maybe that's why I can't reconcile the notion of setting it aside. And maybe it is, part of a tax avoidance strategy. I don't know. But to me, it's setting yourself up.
It's a little bit of a prepper mentality too, I think.
And that may be. But to me, what better way to be prepared than to have things working for you at all times.
Agreed. Well, and gold or silver sitting in the safe will appreciate as opposed to a dollar bill.
Yeah.
So if your reason for doing it is the preparation for future circumstances, gold or silver will it'll accomplish the same goal, but it'll appreciate each year.
Almost all commodities appreciate, and they will appreciate either with inflation or they will appreciate against a decreasing value of the dollar. So you're going to experience that they are at least keeping pace at all times with inflation. There are times that they will go down in value, but if you look at the pricing, as long as those commodities remain useful, which the value of gold is because it's a commodity, it has a usefulness, it has a perceived usefulness and value as well, which makes it more valuable in being deemed precious. Thus, there is the deemed scarcity. It's something that we recognize, but additionally, it does have a historical association with, of course, currency and trade. So there is an increased value even within gold with how we perceive it, but all commodities are going to do the same. Paper, non-metal, not on a gold standard, nothing that is backed, is only going to depreciate in note form. It's going to, because inflation will occur and it will not go up relative to that inflation. So that to me, it may be part of a prepper mentality, and that's fine. I encourage everybody to be prepared.
Yes.
But that is one area in which the holding of currency is ultimately potentially working against you. I look at some of the stories that you've probably seen, little things that come up either through social media or just news articles of the curiosities, where they find $20,000 in a safe in Grandpa's basement, something like that.
Yeah,
that was a fortune when
back
he
then.
put in there.
Yes.
When that was put in there.
Yeah,
you find
saved for years.
Yeah, $20,000 in the basement in 1930s bills. That would have bought you 3 houses then. I think my father tells the first house that his dad built in Dubuque, Iowa, in the early 1950s was something like $6,000. In the 1930s, if you stashed away $20,000 or $10,000 or whatever it may be, that was an absolute fortune. It's not the case now.
Right.
And certainly there are other things that have more significant adjustment or growth in their value. Referring again to the chart that we alluded to before, we're going to see that one's primary residence is the vast majority of their wealth in most bands until you get to a gross level of wealth.
Yeah.
And once you're at that point, yes, there's anticipation of other things being more valuable in your overall portfolio. But there are so many things that will appreciate or accelerate in value at different levels. To be sitting in cash that is not working for you is ultimately leaving yourself out of that opportunity, that the investment, the commodity, the property, whatever it might be, will accelerate at a rate commensurate to or potentially ahead of inflation in most cases.
Yeah, got it. Okay. So, along the cash flow line.
Yes.
I mean, obviously, again, want to clarify, this is not strategy. Talk to your personal financial advisor. But what kinds of things are available out there to invest in that do provide a quarterly or a monthly or even just an annual cash flow?
Again, no advice here. Speak to somebody about your personal situation. But if one's looking for liquidity as well as yield, high yield savings, money markets are still at relative highs. I started in, again, January 2007, and I recall that we had a savings account with the institution that I was with at the time that was at 5.05%.
Yeah.
And that was outrageous. Now, this was early days of online banking, and there were promotional rates and different things that they were able to take advantage of that gave that ability. But I had not seen rates on liquid cash anywhere near that until kind of the last year and a half, 2 years. With interest rates having raised to relative highs, we were able to see that the yield then on cash, on money markets, on high yield savings was similar. And yes, obviously we had a couple of years of inflation that outpaced that, but we've also had a return to more normalcy with inflation. And as a result,
disinflation.
We fell into disinflation.
Okay.
We've had moments of disinflation.
Gotcha.
But the average inflation rate has fallen back down into the low threes, and for a short while was in the twos, which is part of why the Federal Reserve adjusts interest rates, is to
Right.
push those numbers. But with interest rates high, inflation tends to be low because the ability to borrow money becomes more difficult. It's
Right.
quantitative tightening as opposed to easing. And with that, we saw that the yield was higher than the inflation rate on a number of cash positions. And that was and remains, for people who don't have high interest rate debt, a fantastic position to be in. It
Right.
offers liquidity as well as offering a nice rate of return. Interest rates, again, they were announced today that they've come down 1/4 point and that there are potentially 2 more adjustments due this year. With that, any savings product, anything along those lines, is going to see its rate go down. To that end, for people who are in a position that potentially can lock things in for a longer period of time to create that cash flow, there are times that I'll recommend buying a bond that has a fixed rate associated with it. There are times I would recommend investing in a dividend yielding stock where the interest rate relative to the price of the stock might vary, but the dividend it yields tends to be static. They can adjust them downward. Historically, they tend to move them upward. And then, of course, looking at what the history of that company is for how they have handled their dividend is important.
Right.
There are a number of mutual funds, ETFs, other products that are specifically looking for investment in generating a yield.
Yeah.
And then as
REITs?
real estate investment trusts can result in decent yields. They're oftentimes, I would say, they're oftentimes used for the ability to write off some of the losses associated with the cost of the property and oftentimes even the deflation the depreciation, not the deflation part,
right.
The depreciation of assets associated with that real estate investment trust. And yes, they can have good yield associated with them, but they also come with a complication of tax strategy because you now are entering into a partnership. So that is something to consider, but it is something that I would recommend. You have to consider where you're holding it and how is that going to impact your tax filing.
Right.
As an individual, yes, as an individual, you simply have to file the K-1. But then if you're a corporation and you're holding it within, you've also now entered into a partnership as a corporation, and there are other considerations that you have to take.
Okay.
So that real estate investment trusts oftentimes will have some of the highest yields. They can have great cash flow, but they also, because you are depreciating assets, can result in capital losses that may be more than a company or a person is ready to take on.
Yeah.
They have to be carefully considered. Mm-hmm. I mean, all investments have to be carefully considered,
naturally.
but the more specialized you get,
your appetite for risk.
Entirely, yes.
Yeah, gotcha. Okay.
And then of course, there are insurance products that can provide some of the best guaranteed rates of return at the cost of liquidity.
Yeah. Okay. Great. That's fantastic. This is great. So make sure you go talk to your financial advisor and have a conversation with them about including some cash flow options in your portfolio.
My biggest piece of advice, and hopefully that throwing that word out there isn't a red flag, but my biggest piece of advice is to not worry so much about comparing one's position to somebody else and saying, they have revenue of this, they have cash flow of this, they have these holdings. I saw what they did. They have the new fleet, they have the new truck, anything along those lines. But to look at your absolute position in terms of where you are with all of your holdings, all of your obligations, but then also look at your relative position in terms of what is the relative rate of obligation to monthly revenue,
right?
In order to address that cash flow. And the more you can free up, the more opportunities you will create for yourself to either double down within your business, pay yourself a little bit more, put yourself in a position to have to incorporate a new tax strategy, or to invest.
Yeah, that's great. I love it. So now you know what to say when you're talking to a financial advisor, right? And what to ask for. Just kind of last note here. I shared this graphic with you before, and
this is the one we've alluded to, or I've alluded to.
Yeah, a couple of times,
Yeah.
right? Yeah, we will throw it up for the video so that those watching on YouTube can see. But we also have a lot of people listening to the podcast. So if you might explain kind of what you're seeing here and then maybe expound on your thoughts when it comes to this graphic.
Well, within the illustration, we see first that for those at a lesser overall net worth, their cash position tends to be higher in terms of its relative percentages than at any other point. That decreases throughout different bands of wealth. We see that for the first three bands, which ultimately bring us to relatively $1 million in total net worth, that the value of the primary residence is the vast majority of that wealth, and that becomes immensely less significant in value over 10 million, at which point we start to see that the value of business becomes more and more the predominant aspect. And I would encourage people to look at this not just in terms of aspiration, but in terms of self-realization.
Yeah.
Because this makes sense. For individuals with a net worth under $10,000, the primary residence isn't as great a percentage of value, typically because for individuals under $10,000, they aren't likely to own a primary residence.
Oh.
They're renting.
Yeah, that makes sense.
So it's fewer individuals that we take this into consideration. So it may only be a third of those reporting that's going to be part of their value. So for others, It's a zero. Once you're at a net worth of $100,000 to $1 million, I would anticipate, and it would likely be from a necessity as well as appropriateness, just this being the right thing, that the majority of your value should be in your home. It is a necessity that you have some nature of dwelling, some residence, and it is a significant financial obligation and one of the first areas in which we build wealth, because each payment has both a reduction in principal well, each payment has a reduction in principal, but also with each payment, we have one more month in which the value of that home may have inflated. So we have reduction in principal, reduction in the liability, growth in the value, which creates the equity.
Right.
And so that is going to have a more significant impact. But what I really want people to highlight for themselves if they look at this is it's not until individuals have a net worth of more than $10 million that I would argue that their business investments or business interests are a substantial aspect of their net worth. And that's not to encourage people not to grow their businesses. Yeah. It's to say that there are other things that must be looked at first before you get to a point of putting all of your equity back into the business. There should be more focus on cash flow, on providing for the people reliant on that business than in reinvesting within the business in such a way that does not generate outward cash flow, that does not generate revenue. Once you get down to the bottom, we're talking about billionaires. Yes, the majority of their value should be in business interests, in the equity of the business, because there isn't a person out there who can spend money at a responsible rate high enough to decrease the value of a billionaire. Your business equity is going up in value so greatly, and you have other income generated through it at a lower rate in terms of percentages to its overall value, that it more than provides for all of the necessities. At that point, we start to see that their home is effectively, or their residence is effectively 1% of their net worth or less.
Yeah, right.
And that it makes sense.
Or residences.
Right. And we can't compare ourselves at $100,000, $1 million, even $10 million in net worth to people who have $100 million or $1 billion in net worth in terms of where we allocate our value and, redoubling it within the business. For one, Jeremy, you and I have different financial pictures. I don't know yours exactly. You don't know mine exactly, but we know they're different.
Right.
But we both pay the same amount for gas.
Right.
We both pay the same electrical bills, the same electrical rate. Those things don't go up so substantially as your wealth does. So your ability to use discretionary money to grow your business, to focus on that, is greater once you get to a point that the phone bill, the gas bill, the utilities, they don't mean much anymore.
Right. Yeah.
But as long as you are, like the rest of us, blue collar, as long as that, and I still identify myself, I'm a blue collar person in a white collar role, so I still identify myself as such. But as long as that is where you find yourself, then there needs to be the focus on the day-to-day, month-to-month, keeping things operating, as opposed to taking it all and putting it back into the business, denying yourself or focusing on value rather than cash flow.
Right.
And I think that's your message over and over to your clients is, what does this do on a monthly basis to generate the necessity or the necessary income to cover all of your expenses and provide you a living? And once that's considered, once that's all taken care of, then money can go back into the business. Once all of those things have been built, but you'll see on here that one of the first areas that grows is retirement assets. And then even before the business values grow, when we're in the $10 million range, we see that the value in mutual funds is just as great for most people as it is in their business interests. And so with that, we recognize that it's only at a point at which the business is so much its own brand and not the brand of the individual running it, that the money is primarily focused on building back within the business.
That's awesome. I love it.
And by all means, if somebody has a different take, a different interpretation of the data, I think Jeremy and I'd both love to hear it, love to open the conversation on that.
100%. Yes.
Because I think that is where we get our best ideas, is in people saying, but this is how I've made it work for me.
Yeah.
And again, we never want to go down the road that somebody else has already paved entirely, and we don't want to. I forget if it was before the mics were on or or not, but I had said, it's great to follow others' examples and learn from their experiences, but you also don't want to go and try to harvest the same row that's already been plowed.
Right.
And
Yes,
with that, we want to look at it and we want to say, well, great, these models that we see in this chart, this is based on what others have done. However, it's not the end all be all. It's just an average. It's an amalgamation of people across these levels. And we'd love to hear how people do things differently and the value that they find in it and how they strike that balance, because there's something to be learned at all times from it. And that is going to play more to the individual, their emotional needs, their risk tolerances, and their personalities as to how that can be most valuably utilized for them.
Yeah, that's awesome. All right.
Well, Jeremy, thank you so much for having me on. I hope
I want to do a couple of things really quickly. First of all, guys, I know like 40 different financial advisors, and I'm very stingy about who I refer people to, and I happily refer my clients to Rob.
Thank you. I appreciate it.
And everybody could benefit from a conversation with Rob to better understand their financial position and just get a better direction with their money and a better understanding of it. If somebody wants to schedule a time with you and come meet with you, what's the best way for them to do that?
I actually would ask you, reach out to Jeremy. I'm not, he can direct you to me. I'm not here to promote myself, and I certainly don't want to blur any lines between
legally
question and answer and making this promoted of myself.
Yes, right.
So if there's anything that you have questions on, please reach out to Jeremy and he can put you in touch with me. But again, not here, A, to promote myself, and B, don't want to blur any legal lines.
Right. Yes. Got to keep it above board there. So there it is. But any closing comments on things?
No, I highly encourage everybody. Obviously, if you're listening to this podcast, you're already keeping in mind the importance of cash flow within your business. You're already keeping in mind the importance of balancing the needs that you have with the abilities that you have to expand within your business, and you're listening to or potentially even working with somebody who has been in the trenches, gone through this. And I just encourage you to keep that dialogue open at all times, because it's so often so easy to become blind to our position when we don't discuss it, when we don't think of it, and we instead just say, well, I'm just going to put my head down and work harder tomorrow. That's great until you can't lift your head back up, until the will, the spirit, the body, something gives. And at no point should you be without a plan for when that time comes.
Right. Awesome. Thank you so much again, Rob.
Oh, no, my pleasure. Thank you so much. It's great just to catch up and chat.
Yeah. And for all the profit hackers out there, we'll catch up with you on the next episode of our podcast. Thanks for listening. If you found this episode helpful, please like and subscribe for weekly episodes to help you fuel your profit, level up your cash flow, and finance your growth. Until next time, go enjoy some green M&Ms and protect that cash.